in the previous video we have seen the balance sheet, but in balance sheet we had not gone in detail about working capital. In working capital is equal to current assets minus current liabilities. We'll understand what all things come under current assets. I hope many of you all know what all things commonly come under current asset. Cash slash bank, debtors, net, bills, receivables, both prepaid in expenses, outstanding, that is accrued income, sixth, inventories, which is very important, and then short term slash marketable investments. Then what all things come under current liabilities? First, creditors. Second, bills payables. Advance received. Outstanding, that is accrued expenses. Bank OD, that is overdraft. Cash credit and advance income. Okay, I hope this is quite clear. Please pause the video and copy this much first. I hope you all have copied. Now let's once go through over the vertical format of balance sheet for ratio analysis. Sources of funds, from which sources the company has received the fund, either from owner's fund, that is equity preference, then reserves and surplus, which we have carried forward from the previous year, then losses and fictitious asset we have to subtract from reserves and surplus, and miscellaneous expenses which has not been written off, then funds from that we have borrowed, that is secured funds, unsecured funds. The total of the sources of funds gives us capital employed. This much is the amount of capital that the company has employed. Then we'll see applications of fund. In application of the funds that we have received are applied in the form of fixed asset, that is tangible assets or intangible assets, or whether they have invested into long-term investment, and then working capital, that is current assets, current liabilities. Okay, then the total of applications of funds give us total assets slash total funds employed. Okay, hope quite clear. Now let's move on to the ratios. First, current asset. It is a very popular ratio. Current assets, the formula is, sorry, I have written assets. Current ratio, the formula is current assets upon current liabilities. With the help of this formula, we will come to know the capacity of the company to pay off its liabilities, that is current liabilities. Okay, so from where do we get current assets and current liabilities? From the balance sheet under the head of working capital. These are all. So now you all might be able to understand why I have stressed on the balance sheet and on the ratios. Ratios, I'll write formulas. These are very important. Uh, this is This is a video lecture. If it would have been a live lecture, I would have made all the students to recite the formulas at least thrice so that the formulas get registered in their brains. So if possible to the viewers, please write the formulas and please recite it thrice and understand the meaning of the formula. Why the formula is been calculated. What does it gives the result. What is the end result? Okay. The end results are this. With the help of the formula, we come to know the capacity of the company to pay off its current liabilities as compared to its current asset. That means it is having sufficient amount of current assets to pay off its current liabilities. Hope quite clear now. More than clear. If you want to write that explanation, rewind the video and write it down. Okay. Liquid ratio. Presentation is on your own. Please write in such a manner that it becomes interesting for you all to read, because formulas are really boring at times, but because of this explanation it might become little bit interesting. Liquid ratio is equal to current assets minus, just a second, current assets minus stock minus prepaid expenses upon current liabilities. This ratio is also called as quick ratio or asset test ratio. You can find this explanation in practice manual also, so I am not teaching something wrong. This ratio help us to calculate how liquid the current assets are in paying of its current liabilities. I'll explain this particular statement. See over here, current assets, this is very liquid. This is not so liquid because debtors may do delay in paying off the debts. Bills receivable same for as debtors. Prepaid expenses are also subtracted. So then outstanding or accrued income, inventories, short term and slash marketable investment. So these are the mostly liquid current assets. I hope this is clear. See, this cash and this are quite liquid. This is readily available. If you sell it, you can immediately get the cash for paying off all these current liabilities. Okay. Third, more what we can say is more stricter version of liquid ratio is absolute liquid ratio, absolute liquid ratio slash absolute cash ratio is equal to, here we will not write current assets, we will directly write cash plus bank plus marketable investment slash short term investment. Okay, divided by current assets. I hope quite logical for you all. This ratio is very much more logical than liquid ratio, because over here only current asset is subtracted from stock and prepaid expenses. That means debtors and bills receivables are also included in it. Okay, over here if we take a reverse view, here current assets minus stock minus prepaid expenses minus debtors, then minus bills receivable, and then inventory is also so stock is same, one and the same. So it becomes more liquid. That means the remaining part is cash and short term slash marketable investment. So better I'm writing in this manner only. Okay, if in the exam it is asked absolute liquid ratio, write either in this format or write current assets less stock less prepaid expense, or better I will write or current assets minus stock minus prepaid expenses minus debtors minus bills receivables, etc. I hope now it is quite clear to you all. Current liabilities, I'll write etc over here minus. Okay, I hope this is quite clear. So firstly, please pause the video and copy this much. I hope you all have copied this much. Please pause the video and copy this much. And write this explanation. This ratio is the stricter version of liquid ratio. Okay, it does one and the same. It helps us to know how liquid the current assets are to pay off its current liabilities. I hope this is quite clear.